करे तो करे क्या, जाए to jaye kahan. Now that is something that might hit a chord. If yes, you're not alone because you're seeing the way the markets are behaving. The Sensex did not move towards that 1 lakh mark from its high of almost 86,000. On the contrary, what did it do? It has now settled below 80,000. And yet, a grim milestone has been reached this Diwali. FIIs, viewers, and listen to this carefully, FIIs have pulled out a staggering 1,02,268 crore rupees from the market. It's all happened this month as we speak. So there is a certain piece of good news though. The domestic investors, the DIIs, they're trying to fill this vacuum that has been created by the FIIs, and they've pumped in 96,500 crore rupees in the cash market. So this is what we are asking this evening. Is this a time to buy the fear or to run for cover? And to answer those questions, Ajay Bagga is joining us, independent market expert, along with senior market analyst at Equity Group. Farah Murad is also with us this evening. Great to have you both, and thanks for making the time just ahead of the weekend. Ajay, the FII sell-off is one factor, the stretch in valuations we've spoken about, a potential economic growth slowdown, and also weak corporate earnings. Considering all these factors that are at play, is this the time to buy the fear or run for cover?
No, I think we can wait. There's a big event coming up on November 5th in terms of the US elections. And I think neither taking cover is needed. The regular investments for the retail Indian investors, those go on. But fresh positions, we can wait. I think with $10 billion gone out, our own estimate is that there is a bit more left, and maybe $3 to $5 billion go out more. And so we can wait out. The patterns historically are the recovery will also be quite sharp, quite concentrated, and it will recover very fast when the recovery comes in. But right now, we are not very sure. I think we can wait for this big event to be out of the way and then look at fresh allocations.
That despite the factors that seem to be working, pulling these markets down, the question is about liquidity, whether or not it's helping offset the impact of the headwinds that the markets are facing currently. Ajay.
Oh, sorry, the first part got cut off, Vikram.
Right. No, I was saying that despite all these factors, all these headwinds that are at play in the markets, isn't the liquidity in the markets helping offset their impact?
Yeah, liquidity is helping. And if you compare calendar year 2023 to 24, the run rate right now is pointing to slightly lower than 2023. 2023, we had 5.4 lakh crores of investment by the retail investors in the secondary markets. This year, we are looking at about 5.2 lakh crores. We are just short of 5 lakh crores right now, with about 2 months and a week to go. So the run rate will be less than last year, but still it's very good. Overall, about $51 billion has been invested by the domestic investors in these markets in calendar year 2024. And that's really held up the markets. The FIs are now down to a net inflow of $2 billion. And I think before the next 2 weeks are over, we'll probably be at a negative print for FI flows for this year.
Well, that would sound very reassuring to investors here on Dalal Street. But Farah, what about Wall Street? There is an impending election. And just ahead of that, the market has become very volatile. Wall Street certainly has, notwithstanding what's happening with Tesla, which has had this great run. But it is going sideways now, coming a bit under pressure. Is it just nervousness around elections, or is there some shift in the fundamentals that you see?
I mean, let's see it that way. I don't think investors are afraid. It's just that maybe, as I was hearing, taken hold a little bit on the stock market. If we want to think as an investor right now, if I want to invest in treasury yields for 10 years, for example, it's giving me a yield of 4.2%. While if I want to check with this high valuation of indices, S&P 500, for example, it's at 3.8. So why would I join now or invest in the stock market while I have a less risky market that's even giving me a better return? So I think that's also something to take into consideration. Yes, the volatility is spiking. I'm seeing the first time as well this huge amount of long of hedge funds on the VIX index. So all of this together, yes, we're taking some consolidation around the elections, but the same thing is also when I want to compare markets, the stock market with less risky, whether it's a safe haven such as gold or it's the bond market, both of which are giving me really good returns, which making me maybe a little bit hold on the stock market for the meantime.
Yes, certainly. One would have to agree with that, Farah. The surge that we are seeing in bond yields, that's definitely not a very good environment for equities. But do you see these bond yields go up higher in fear of a Trump win in particular? Are the markets primed for a Trump victory, you'd say?
I mean, I highly doubt maybe there will be a little bit of volatility around the election and post-elections, but I genuinely think at the moment that whoever wins, they have very limited room to create really very different policies, especially in the first quarter. So I highly doubt there will be huge changes. Actually, I think, yes, the dollar might be supported, the yields might be supported, but maybe for different reasons. Given that the US have stronger fundamentals than other, I would say, developed economies, such as the Eurozone, such as the UK, that's mainly why I am betting more on the US Treasury yields more than who's going to win the election.
Do you buy into this? I was asking Farah, Ajay, about the possibility of a Trump presidency now, because if you recall, that presidency that he's had in the past has seen one of the biggest bear markets in the small cap and mid cap stocks. And that happened specifically, if I remember correctly, Ajay, from January 2018 to March 2020. So I was wondering if that fear is growing in Indian markets as well right now.
No, in fact, the Trump presidency will be mildly more positive for India. There is talk of tariffs, but again, the rhetoric during the election season and the actual action sees a very big comparison. There's a very big difference on how politicians act when they are actually in power. So those 60% tariffs and all are not going to happen because that will lead to such a huge inflation in the US domestic economy itself that no politician can survive that. So this is more rhetoric. India, I think, is well served by a Republican president. The Wall Street positioning is for a Trump victory. The Indian maestros who have been coming even on your channel, Vikram, through the day are more or less factoring in a Trump victory or at least Republican control of the Congress and the Senate, which will again, inhibit Kamala even if she wins the election. So overall, Trump is good for the Indian economy. Will be better than a Democrat president, that is for sure. The second part is what has happened post the September rate cut by the Fed. The dollar strengthening, the yields going up has upended EM flows. On top of that, you had the Chinese stimulus and the China Politburo meets again, Vikram. So
Yes.
we are expecting some more fireworks on stimulus. Over the last 10 days, Chinese market has seen outflows actually.
Yes.
So the first $53 billion that came in on the first 2 weeks of hope has seen about 6 to 7 billion coming out now because the stimulus is seen as not good enough. I'll give you just two examples. 36% of the local government revenues come from land sales. Those have dried up totally for the last 1.5 years.
Yes.
70% of Chinese household wealth is sitting in property, which is yielding about -15, -20% if you can sell at all. 124 million, 1.24 million units are sitting there which have been paid for by mortgages but which have not commenced, development.
Right.
So it's a $60 trillion market which is in trouble. The Chinese real estate,
Right.
very highly overvalued.
So you think the stimulus is not going to help as much as the Chinese would hope, right?
Yes.
But,
In
you know,
fact,
even while we're
it's not
talking,
coming
yes.
back in a rush. Yeah.
Yes, but even while we're talking about the Fed cutting rates, Farah, the ECB is cutting rates as well, and we're talking about China. It's sort of trying to stimulate its economy, and like Ajay says, perhaps not making too much inroads when it comes to real estate, which is a big part of its economy. It'll take much more than what they've already done. Do you think? But these are precursors, at least what is happening on interest rates, what's happening by way of stimulus in the Chinese economy, they are precursors to the global economy clawing back in its recovery, because that is linked to how Indian equities will react as well, right? With the kind of exports that we hope from IT services, etc.
I mean, but I would explain it a little bit differently. Yes, definitely growth will help everyone. But then if, let's say, Trump is the winner, and then I think on an international scale, maybe China would be more afraid of tariffs and new regulations. And this also will be helping the Indian economy. So I don't really think it's related, whatever is happening in China and internationally with India. I still bet on, yes, international growth would help the Indian economy. It is a very good competitor for China as products, as exports, and probably better relationship with the US compared to China. So overall, I think this would keep me bullish on the Indian economy. Now for China, also, whatever happened before last September was a little bit shy, because the Chinese government had this dilemma. Should I support the yuan or should I support the economy? And they really had very small room to react. Now, given this huge movement, over 70% of central banks around the globe, they are dropping their interest rate, and especially the federal bank.
Correct.
Now they have more room for more liquidity to be injected. I think the last maybe measures that came last Thursday wasn't really that promising for investors. The fiscal plans weren't really clear, but still there's sectors that I can still bet on China because of how cheap it is right now. Tech stock, for example, online shopping, electric cars. With this new BRICS movement, I think still there's very interesting sectors in China.
So you're saying the Chinese markets are still looking attractive, notwithstanding what Ajay is saying, that perhaps the stimulus is not going to be enough, and the sparkle that the Chinese markets hold, at least as of now, because this entire credo which has come about sell India and buy China, perhaps may not hold true for a longer term. But Ajay, you were talking about market veterans being on our channel. Madhusudan Kela was here with us as well, and he said that right now, return of capital is the first priority. Return on capital is the second priority. He says that if you are intoxicated, believing that the bull market is going on and you can do anything, he says that phase is over. Do you agree with that?
Very difficult to say that. But, on the other side, Morgan Stanley has brought out an interesting report, Vikram, on how the ROEs have gone up. The companies have really cleaned up their balance sheets. There's a lot of embedded operating leverage sitting in Indian companies. That's why you get the 20 times price earning, and China was at 9 times. Now it's gone up to about 11 times after the recent surge. So I would more be happy with that return on equity. Our overall market is sitting at 16% plus return on equity. So there is a move to quality, to large caps, and there was frothiness in small cap, mid cap. It is getting corrected out, but still at 25 times price earning, there is some way to go in those pockets. But return of capital is an asset allocation business. See, when you get into equities, you get in for 5 years, 10 years. As a trader, there are no bets, whether you will get return of capital. But on a 5-10 year basis, you are very much assured that 5 to 6 years in India, you double your money. And in about 11-12 years, you will quadruple very easily. And if you had good portfolio picking skills, or if your fund manager was doing well, you could even do better. We have seen that, in fact, over the last 6 years, from if you say 2018 to now, there are a lot of funds in India which are up 3 to 4 times, Vikram. 5 years we have
betting
given
on, I was just saying that about financials, for example, if you just take that sector, it has been holding up. But can you expect that to continue once the RBI kicks off its rate cut cycle, for example? Because there are certain pockets that will hold up and certain pockets which will lag. Just wondering where financials fits in, which has been performing in recent times.
I think the correction that has happened and the ferocious selling by the FIIs, about 5 days back, they had sold 23,000 crores of financials already in the first 2 weeks of October. That would have gone up further. And today, especially the way Bank Nifty fell, our Nifty Finance fell, I think a lot of selling would have happened. So FIs were overweight on financials, and we have seen furious selling happening in October. So maybe as markets are forward discounting mechanisms, we have discounted that, okay, RBI will not cut in December as we thought earlier. Maybe they'll cut in February or April, but the cut is coming. NIMs tend to compress as the rate cuts come in because your loans, your repricing takes time. The deposits are running, they are locked in at higher rates, and banks have been really in a competitive bidding war for deposits. So
yes,
NIMs will compress and some margin erosion comes in, Vikram, with the rate cuts.
We were talking about corporate earnings at a larger level. And if I can ask Farah, because back home, we're talking about Q2 earnings looking rather weak. And perhaps that is what we are correlating as one of the fear factors that's building in, that consumption in India is kind of running low. The economy is slowing down, and perhaps that's what we're extrapolating. But if you look at an overall global level at how earnings are panning out right now, Farah, what's the sense that you're leaving us with? Is this a global phenomenon, or is this something that we're experiencing just in India?
Actually, I think we need to also see how the markets usually expected to, or what they expected to see from these reports, because somehow they're okay. We still need to see the Magnificent Seven. Tesla was the first, so we still need to see more of the tech sector. But overall, the earnings are okay. It's just that the market always expected over the last too many years, 20 years, to have above expected, or the forecast to come, or the numbers come better than the forecast. So somehow that's not being delivered right now. We have good cash flows for the bankings. They're really doing well, but it's not coming way above expectation. And also the forecasts are not really super better than expected. And I think that's what's keeping the market from having a more bullish momentum.
Yes,
not
many
because
would say,
we have bad reports.
absolutely. Many would say that back home in India as well. Ajay may not agree fully, but perhaps our expectations of the equity markets have run ahead of what the corporates have been able to deliver by way of earnings. But that's room for another discussion. Ajay Bagga and Farah Murad, it's always a pleasure having you on India Tonight here on ET Now. Thank you so much for joining us this evening.